Good afternoon, everyone. I'd like to welcome the members of the New Jersey Subcontractors Association and the New Jersey Land Improvement Contractors, as well as invited guests to this educational session. For those of you that I have not had the privilege of meeting yet, my name is Buddy Friend, and I am the Executive Director of both NJSA and NJ LICA. During the next 60 minutes, we will learn the latest on PPP, loan forgiveness, and tax considerations for the construction industry. Joining us today are over 150 industry professionals. Our host for today's program is the Withum construction team from Withum, Smith & Brown. They have been longtime members of both NJSA and NJ LICA and have been great supporters over the years. Their support, and we thank them for today's program. Before we get started, I want to express my sincerest best wishes for health to you, your family and friends, and your respective businesses. Please do not hesitate to contact any of us, NJSA, NJ LICA, the team at Withum, if we can be of any assistance. As organizations, we are committed to your future success, and accordingly, we are building a virtual calendar for industry professionals that will be both educational and social. We do hope this will help fill the gap until we have returned to some sort of normalcy. I'd like to introduce today's presenters from Withum. Lou and Dan, you're up.
Hey, good afternoon. This is Lou Sandor from Withum, Smith & Brown. I am a partner and practice leader of the construction services team. Many of you may have seen me at LICA or NJSA events or other organizational events. And I've been at Withum for 30 years, and I'm presenting today with my tax principal, Dan Mayo.
Good afternoon, everyone. My name is Dan Mayo. I work on the, my day job is a tax advisor. And now I spend my time probably 100%, 95, 100% on the PPP loan program. So I'm happy to be here today and look forward to working through the issues. We're going to cover a bunch of topics today. We're going to start with PPP loan forgiveness, talk about whether and how companies should think about returning the funds if that's an issue, then talk about some individual corporate tax considerations, and end with a Q&A session as time permits. We're also going to interject questions along the way, so we encourage you to submit them through the system, and then we can either Luke can read them to me as we work through the presentation, or we can cover them at the end. So let's turn to the next slide, and we'll start with the forgiveness discussion. So I thought we'd just do a brief level set on the terms of the loan before we get into the actual forgiveness. And so we know there's one loan per entity. The maximum amount of the loan is $10 million. The lender determines the amount of the loan based on the borrower's calculations. We know it's a 1% interest rate for a 2-year term. There's no collateral required, no personal guarantee required, and no prepayment fees of any kind. Interest also is deferred for 6 months, but it continues to accrue. And then we'll get into forgiveness, which covers up to the full amount of the loan plus interest. On the next slide. So loan forgiveness, the key to loan forgiveness is what is spent during the 8-week period after the loan is made. So if your loan is made on a Wednesday, what I tell people is it starts that the day you receive that money is a Wednesday. The loan begins at that point, and your 8-week period ends on the Tuesday at the end of 8 weeks. So it covers exactly an 8-week period. And the key to forgiveness is looking at the amounts that are spent during that 8-week period. And so we will show here the list of eligible expenses. But before we get into that, let's talk about paid and incurred. And so the statute talks about expenses paid and incurred, but the way it's written, some people interpret it as paid or incurred. So what we've been advising people is to continue making payments in the ordinary course of your business and make sure that you pay at least 8 weeks worth of expenses on these eligible expenses during that 8-week period. This way, we can ensure that the amount that you pay will be forgiven. But we're making that recommendation because of the lack of clarity regarding paid or incurred, and also because we expect guidance to come within 2 weeks. So hopefully many of you are at the beginning of your 8-week period, and you'll have time when you get the guidance. And when we get that guidance in 2 weeks, you'll have time to adjust if necessary. Others at the end will may have to make decisions sooner rather than later.
Hey, Dan, I just want to talk about this area and make sure the members understand. We have been getting a tremendous amount of questions on this topic, and I've also been a view on many, many webinars. So from a businessman's perspective, payroll cuts off all different time periods. Could be monthly, could be semi-monthly, could be weekly. And you're going to have a period of overlap from the date those funds were received, a payroll overlap, which starts the 8 weeks, and also at the end of the 8-week period. We've been also getting questions on SUI and DIS, which are the state taxes that are allowed. Those are paid quarterly to the state of New Jersey in the filing. And we're also getting questions on union dues. The union dues reports are prepared monthly. You need the payroll in order to prepare them, and then you remit a check the following month and a half. The same thing with medical. So the accountants, as you know out there, which I'm one of them, and you're, I guess, wearing two hats today as an accountant and an attorney. The accountants, we live under the rule of accrual basis. When an expense is incurred, it's deemed to be for that specific period, the matching concept. So a lot of people out there believe that it's accrual method. So with your comment is pay to be safe.
Absolutely. We just don't have the guidance. We know that the 8-week period is important, and we know that forgiveness is keyed off expenses during that 8-week period. So if for example, nothing were paid during that 8-week period and were just incurred, probably would get no forgiveness, and that's consistent with the statute. They want the money spent and they want the money given to employees. So paying is obviously important. Until we get guidance, we just don't know how they're going to interpret this. So we have to recommend that you pay the amounts during the 8-week period, even including making a catch-up payment if necessary. Now, we don't recommend large out of the ordinary type payments. We do recommend you keep your schedule of payments in the ordinary course of business, because as you mentioned, if you have bi-weekly payroll and it's 1 week after your 8-week period starts, 1 week will be before the 8-week period and 1 week will be during the 8-week period. At the end, though, on the back end, your last payment won't come until after the 8-week period, which will cover the last week of the 8-week period and a week after. So it will even out. As long as you pay 4 payroll cycles during the 8-week period, it should even out, unless you ramp up hiring at the end of that 8-week period, in which case we recommend you may want to make a catch-up payment at the end. But again, hopefully we'll have guidance before that point, and we'll have better sense of what it means to be paid and incurred. Is it and, is it or, and exactly what they're looking for, and then we'll have a better sense of whether a catch-up payment is needed.
And that period, that 8-week period starts the day the funds are deposited into your account?
Correct. And if they're deposited over time, it's the day of the first distribution, the first payment you receive. Okay. So if you're getting $1 million and you get 100,000 one day and 200,000 a week later, it's that first day you got that 100,000.
Perfect.
So we'll continue on now with the eligible expenses. And the eligible expenses are very similar to what everyone will recall from determining the maximum loan amount. First is the concept of payroll costs, and this is the payroll costs, your wages, salary. It includes things like your compensation, the retirement benefits, healthcare benefits, your SUI, and unemployment and payroll taxes. But it does cap the salary at 100,000 per employee on an annualized basis. And when you look at that as 8 weeks over a 52-week period, it comes to $15,385 is the maximum wage, plus the other items, the retirement, the healthcare, et cetera. It includes interest on mortgages, rent under leases, and utilities, all of which must have been in service or under a lease before February 15th. And the goal there is to prevent people from putting new leases in place or related party leases in place. And so they want to make sure that it's a somewhat long-standing obligation before they cover it. The amount of forgiveness cannot exceed the principal amount of the loan. I think that makes sense, right? You can't forgive more than someone's received. And here's the key, that no more than 25% of the amount forgiven can be for those non-payroll costs, or what I call the overhead expenses. And those are what you think of: the interest, the rent, and utilities. Those are the 3 overhead type expenses. And the rule is phrased as a negative rule, but I would flip it and say it's a positive rule. And what's happening here is the government is using employers as a conduit, right? And the goal of this program was to keep people off the unemployment rolls. And so the government's passing money through to the employees. In exchange for the employer doing that, the government's paying the employer 25% of the forgiven amount. And that is the overhead expenses. So the more the employer pays its employees, the greater that 25% will be, and that can be included in the forgiven amount. So I encourage people to think of this program in that way, that the amount of the overhead that is forgiven, that should be viewed as a form of compensation for passing through the payroll to the employees.
Now, Dan, it's we're starting to do some top-sided calculations with some informal information we have. And I just want to warn the viewers, believe it or not, it is not easy to get 100% forgiveness. It is actually a challenge. So with that challenge, we are getting these unusual questions. When it says utilities and transportation, is that vehicle gas? I know for Schedule Cs, there was some clarification that gas for a vehicle may be allowed for self-employeds. You're talking the construction industry. You've got a ton of off-road diesel. You've got tons of tolls. And you've got equipment rentals that may not necessarily be leases, but weekly, monthly, or semi-weekly rentals for equipment that has been in the field for quite some time to get the construction job done. So we're getting challenged with a lot of questions on what can we throw in that 25% number. And it's not that easy. I just wonder if you can give us any input there.
Yeah, so that's true. This is a problem for all industries, not just the construction industry. I was talking to a client the other day. They had 13%, and we ran an estimate of their forgivable expenses. They only had 13% in overhead. So we were trying to maximize that out, thinking what other items can we fit into this category of interest, rent, and utilities. In the construction industry, the key point, as you're mentioning, for utilities, electric, gas, and water, somewhat known commodities. But transportation is the real uncertainty here. And the only guidance the SBA has put out is they've included gasoline for a rental car, a leased automobile, as a part of that utility expense. So the construction area, I think, has a lot of leeway in this area to put in a bunch of these expenses into the utility category that other industries will not be able to do. On the rent side, rent is pretty clear. It's rent for a building, could also include leased automobiles. And interest on mortgages is another one of these quirky definitions. It's interest on a covered mortgage includes interest on real property for which there's a mortgage on the property, a lien was put on the property. It also includes loans like working capital loans, as long as there is a UCC1 filed. And UCC1 is just a lien, a security device, just like a mortgage. And so if a UCC1 is filed against the assets of the borrower, then it's a covered mortgage. And the interest on that mortgage can be included in the overhead expenses for the forgiven amount.
So if I have a piece of construction equipment that I entered into a lease agreement before February 15th, that piece of construction equipment is collateral on that lease, and it's been in the field and being utilized since February 15th. That may be a covered commitment.
Yes, and strangely, I know it's strange, it depends on whether a UCC1 was filed.
Okay.
And I think what they were getting at there was they wanted to eliminate related party loans and related party interest in mortgages, that kind of thing, because a related party is not necessarily going to file UCC1 or a mortgage against property. That might have been the genesis of that requirement in there.
Okay.
So moving forward here, the amount of the forgiveness is tax-free to the borrower, but this is important too. Now, there's no deduction for the expenses that are paid. So the IRS issued this ruling late last week. They issued a notice, I think it was 2020-32, that denies the expenses under Section 265 of the code. I won't get into the details of that, but the way this works then, that the amount forgiven is tax-free, but the borrower does not get a deduction for the expenses, which makes sense if you think about it. It's a wash from the borrower's point of view. They're indifferent. The government's paying these expenses. They don't have to pay tax on the amount. They also don't get a deduction for it. That makes sense. There is some talk that the legislators are thinking of trying to get this fixed. They're trying to get that deduction reinstated. So if they do, that would be a big tax benefit for businesses, that they could deduct the amount of expenses that were paid, even though the forgiveness was tax-free. The way forgiveness is going to work, there's going to be a borrower is going to submit an application to the lender after the 8-week period. They're going to document their expenses that were paid and have to provide documents to the lender. And the lender then will have 60 days to render a decision on that application for forgiveness. We haven't yet received any application forms on what that application forgiveness will look like, but we know it's going to model the calculation, and we know it's going to have some kind of representations from the borrower to make sure that the expenses are including. They really want to put the borrower on the hook for fraud. And so they want the borrower to sign something probably under penalties of perjury, just like the loan application, to ensure that people really scrutinize these expenses they're asking for forgiveness on and don't try and throw everything, including the kitchen sink, in there. So we turn to the next slide. This is just a more detailed definition of that payroll costs. Again, this looks familiar to many of you since it was used in calculating the maximum loan amount. You got wages up to 100,000, it excludes independent contractors. It's got your dismissal or separation payments. This is something that is surprising to a lot of people, but they are included in there, and they appear to be in addition to that $100,000 cap. So if someone is terminated, but I am cautioning people, if you just, one client wanted to dismiss someone within the first 2 weeks of the 8-week period, I said you can do that, and the payment is included in the definition of payroll costs, but you will lose the FTE for the headcount reduction rule. So it might make sense to keep the person employed for the entire 8 weeks and then terminate them at the end of the 8-week period if that's the plan. And because there are many businesses, think of movie theaters, for example, or the airline business, where the business is not expected to resume anywhere near where it was, before this crisis began at the end of the 8-week period. So there's 2 special definitions for a sole proprietor and partners. I won't spend time on that because it's most people are done with that as part of getting their the loan amount. On the next slide, we'll turn our attention a little bit here to the difference between allowable uses and forgivable expenses. And so this is going to be key. On the right column is forgivable expenses. That's what we just talked about. The salary up to the cap of $15,385. Working down that column is the interest on mortgages, business rent of real property, personal property, and utilities. When we go to the left, so why do we talk about this? Why do we highlight allowable versus forgivable? Because at the end of, there are many borrowers who will reach the end of the 8-week period and will have some funds left, and they'll say, what do I have to do? Can I keep these funds? Can I use them? Can I keep it for the next 2 years? And the answer is yes. This is a 2-year loan. So at the end of 8 weeks, there'll be 2 years minus 8 weeks remaining on the loan agreement. But the borrower, under the loan document that's signed with the lender, is only permitted to use the funds for these uses. And many of them mimic the forgivable expenses, which is what we match them up here on the lines. The difference is they don't have this date restriction. There's no restriction that the money must be, the lease, for example, must have been in effect before February 15th. So working our way down, we see the allowable uses. You have payroll costs. That's the same as what we talked about. Interest on business mortgage obligations and not prepayments. Again, there's no date restriction here, no February 15th date. Going down, there's business rent, business utilities, and these last 2 are the ones that are not forgivable expenses. So interest on any other debt obligation. So this would be interest on a debt obligation where there's no mortgage, or there's no UCC-1 that's filed in connection with it. And 2 is costs related to the continuation of group healthcare benefits during periods of leave and insurance premiums. And this is a strange one they included, and I won't spend too much time on it. I mean, it's helpful if a company's in this situation, but we don't expect many people to be a material item for them. So we'll go to the next slide, and we can talk about.
Dan,
yeah.
Let me interrupt you for 1 second here. So yeah, I think that last slide was extremely important because this was a confusing area. We're getting a lot of questions on what can I do with the money as it's left over, and there really wasn't. It was very unclear. Some people were like, I could buy equipment, I can pay my line down. Based on your last slide, it's pretty clear that if you have funds left over, you can only use them for the purpose of what the original application was used for, plus those other 2 items at the end there. So I just want to make sure that the viewers are aware of that.
Yeah, and they signed a loan. They signed a loan agreement promising to only use it for these items. That's important too. And any other use violates the certifications they made, and also would trigger a default on the loan, which makes it immediately due and payable.
Yeah. So as you know, we're getting a lot of questions on a lot of people are trying to squeeze expenses into this loan program, obviously, and you can't blame them. So if you had a company that typically paid bonuses in June, every semi-annually, what would you recommend? Continue it, postpone it? What if you paid the bonus in July, but then said, you know what, it was really for the June period, we're going to pay it in June instead?
I'd recommend you continue your ordinary course behavior is what we're recommending. And if you normally pay it at a certain time, and if it's in that 8-week period, that's great. I don't think you'll get credit for the full year's payment for the 8 weeks. You'll get 8 weeks worth of credit for the bonus. But if you were going to pay it 2 weeks later, it might make sense to speed it up and get it in the 8-week period. Again, until we have guidance on what that paid or incurred means, we would like to see as many payments during the 8-week period as possible to eliminate any argument on behalf of the SBA that it was not an appropriate forgivable expense.
Thanks.
Another related question too that goes to this is we're getting a lot of questions. Do people ask, should I segregate the money in a separate account? And that it's not necessary. I mean, you're not obligated to keep the money in a separate account. We do recommend that people do. And the reason is we like there to be good tracing of the funds. We'd like to, when it comes to the forgiveness application, we'd like for the borrowers to be able to show a clean use of the funds coming into the account and the funds going out of the account. And we think that'll be cleaner from a documentation point of view, and also from a point of view of not having to disclose the rest of the account as part of the application if they don't want the uses known to the SBA, to the lender rather. And another, when we say that, also we don't mean that you make your payroll directly through the loan account. You can still make your payroll through your operating account, but then reimburse the amount from the loan account to the operating account. So that's just a best practice. Again, it's not required, but we do recommend that to keep a clean tracing of the funds and how they were used, so there's never an allegation that something was done improperly. And it also prevents against, let's say, for example, the company made large bonuses to the owners of the company or large salary payments. We'd like to be able to show that that came from additional funds and not from the loan proceeds. So again, this is about protecting the borrower to make sure they can prove the money was spent on the permitted purposes and that there's no suggestion of impropriety when none may have existed.
Totally agree, Dan. And in the construction industry, some companies are used to doing funds and cash flow by projects as you get to become larger. And in the construction industry, the area we're going to be talking about, the challenges is if your company is still profitable in COVID and is generating positive cash flow, you need to be able to prove that that positive cash flow from operations was used to buy your other equipment, pay your line down, and pay for the non-expenses that are forgivable. So I do like the separate account setup, however, not required.
Mm-hmm. And if anyone's interested in more information, that we have an article on our Withum COVID-19 website addressing this issue in slightly more detail. It was written by a forensic accountant in our forensics practice, so I had an interesting perspective on the tracing point. So go to the next slide, please. This is just a quick example to run through the forgiveness. We'll start with that column on the left, $100,000, and work our way down, and then we'll go to the right. The loan amount's $100,000. The payroll during the 8 weeks was $60,000. So, and the rent utilities was $30,000. So the total amount spent was $90,000. So right off the bat, we know at least $10,000 has to be given back to the bank, right? It has to be repaid. So we go to the next column, the maximum amount that can be forgiven. So we know that the $60,000 is a payroll cost that can be forgiven. Then we get into rent utilities. This is where that 25% limitation comes in. And the $30,000 is 30% of the amount spent, right? 33%. 30 over 90,000 is 1/3. But here only 20,000 can be forgiven because that equals, when you have 20 plus 60 is 80,000. 20 over 80 is 25%. So 20, and the math is there for you if you want to do it yourself with your own numbers. But so that's where that 25% calculation comes in. And then we look to the right, the loan that has to be repaid is that extra 10,000. So 10,000 of the rent that was paid, that's going to be an actual cost because the money was spent and now it has to be repaid to the bank. So that 10 is an actual cost. The 10 that was never spent is not a cost to the borrower. So going to the right, then the loan that has to be repaid, 0 for the payroll because that's fully forgiven. 10,000 for the rent utility that exceeded the 25%, and then 10,000 that was never spent. So 20,000 needs to be repaid to the bank. Again, even though 20,000 was spent, the cost to the borrower is only 10, since that's an amount that was spent on their own utilities, so rent, utilities, and interest that has to be repaid. What we'd like to see, the better thing, sorry?
Yeah, you have to put your math hat back on from school.
Yes.
Definitely. This is like a weighted average, prorated, and it's not as easy as you think, but it does work out properly.
Right. What might have been different here was if the borrower had the payroll instead of 60,000, if they spend 80,000 on payroll, that extra 20, then there would have been 100% forgiveness, because the 20,000 would have been 20% of the 100. So it would have been 100. The 30,000, sorry, would have been, if they spent 20,000 on rent and 80 on the payroll. They would have not breached that 25% barrier. The payroll expenses would be 100% forgivable. So you get into a situation where that extra 10,000, if that were spent here, would have been 100% forgivable. So holding back on the payroll didn't help anyone here. It would have created more headroom for the 25% calculation, and it would have been completely forgiven. So that's sort of the takeaway from the example here. Let's turn to the next slide. This slide looks confusing, but we'll try and break it down so it's not so bad. There's four reductions. Well, we'll start with the two here. There's two reductions on this page dealing that reductions in the loan forgiveness amount. So when you look at loan forgiveness, you calculate what we did on the prior page, the amount you spent on payroll costs and the overhead items, and those are all forgivable, subject to that 25% limitation on the overhead. And then that amount, that's called I refer to that casually as the tentative forgiveness amount. And then from that amount, we're going to have to look at reductions for possible headcount reduction. So our number of full-time equivalent employees went down relative to a base period, and we'll talk about that in a moment. Also reductions based on wages. So if some employees are getting paid less than 25% of their wage in the base period, there's going to be a reduction for that. And these types of reductions are actual costs, because it will reduce the amount that the borrower paid on payroll and overhead will be reduced from the amount forgiven. So this is where a lot of time needs to be spent in managing the forgiveness calculation and making sure that these two reductions do not kick in. And so I think most of the time spent on the forgiveness calculation will be spent here on the managing these, making sure there's no reductions. So let's start with the headcount reduction. What you do is you take a ratio, this ratio, and you multiply that by the expenses paid during the 8-week period. And what's that fraction? The fraction is going to be the average number of FTEs as full-time equivalents. We'll get to that in a moment. But the average number of full-time equivalents during the 8-week period, right? That's the covered period after the loan is made, divided by, and there's two periods here. The borrower gets to pick the one that's most beneficial. And so you have the average number of full-time equivalents from February 15th to the end of June of 2019, or the months of January and February of 2020. So you're going to take the average number of FTEs of the 8-week period over one of these two periods. So naturally, you're going to pick the lower, whichever FTE period, those two options, whichever one has the lower full-time equivalent number. And the goal here is, if you had 10 employees during the 8-week period and you had 10 in your base period, your fraction is 1, and 100% of your tentative forgivable expenses will be forgiven. The way this works here, let's say you had 10 employees in the base period, which is called that January to February 2020. You had 10 employees then, which only brought back 8 in the 8-week period. Well, your ratio is going to be 8 over 10, which is 80%, and 80% of the amount you spent during the 8 weeks will be forgiven. The other 20% will not be forgiven. So that's the way this is going to work. And that's why you can see it's so important to manage this fraction, to make sure you bring back all your full-time equivalents relative to one of these two base periods. So the question is, what is a full-time equivalent? Unfortunately, the SBA has not defined this clearly. We think that they'll come out with some kind of guidance in the forgiveness guidance when it comes out, and we think in the next 2 weeks they're going to produce some kind of interim final ruling. Interim final rule addressing the forgiveness calculation. But there are some online SBA documents we found that provide some insight into how we think the calculation will be done. And based on that, we think they're going to use a 30-hour concept. So if an employee works 30 hours or more, they're considered a full-time equivalent, one person. And then you would count them as one equivalent and then remove them from the calculation. So you add up the number of full-time people, 30 hours or more. Anyone who's under 30 hours, you put in a bucket, and you take the total number of hours of all those people and divide by 30, and that'll give you the number of full-time equivalents. Does that make sense, Lou? Did I go too fast on that?
Yeah, no, I do get confused in this area, and I hope I'm not the only one out there, because I did do pretty well in math in college.
What they're trying to say is you take the full-timers and they're full-time. Of the part-timers, if you had 2 people working 15 hours, You add up 15 plus 15 is 30, divide by 30, and that's one person. 30 over 30 is one. And that's so 2 15-hours equals one full-time equivalent. Three
Correct.
10-hour employees equals one full-time equivalent.
Now,
31-hour employees equals one FTE. So if you
now,
add up your employees and you come to 45 hours, you have 1.5 FTEs.
correct. Now, how come the forgiveness calculation on the last slide had nothing to do with FTEs, but you came up with 20,000 have to be repaid? So is the forgiveness a combination of the two, or is it one or the other?
It's a combination. You're going to first calculate look at your total expenses during the 8-week period, and that's your maximum amount of forgiveness.
That's the max. Okay.
The max. And then we're going to reduce that by the 25% rule that the SBA imposed. No more than 25% can relate to the overhead. And think
Right.
of that as the payment to the lender for participating in this program. The borrower, I'm sorry, payment to the borrower for participating. Then you get into, well, they want to punish you a little bit if you don't bring everybody back. And so that's what these headcount and wage reductions do. They say, we're going to, if you paid 100,000, we're going to reduce it by the amount of people you didn't bring back. And so they're trying to they want to incentivize people to do the right thing and bring all their employees back, put them on the payroll. That's
All
the
right.
purpose of these reductions.
And that gets to your next FAQ 40, because we have had clients where people don't want to come back
Right.
and then let go. So,
Right. Yeah, this FAQ just came out yesterday. And it's interesting because they said that they're going to issue further guidance, but they told us what it's going to be or summarized it. And so if a company lays off an employee and then calls them up and writes them a letter and says, I want to give you your job back, and I'm going to offer you at your same wage that you used to work, and the employee says, no, I'm happy on unemployment, thank you very much. I'm making more on unemployment due to the $600 per week bump up that the federal government's paying for. The employer will not suffer a punishment under this headcount reduction rule or the wage reduction rule.
wow.
And so it's a very favorable thing they came out with, recognizing that there are many employees just don't want to come back. They're happy on unemployment. So I have an example here just to show to highlight two things that were unclear about this. And when they issued this final IFR, interim final rule, elaborating on this FAQ number 40, it may provide more detail. Let's say a company has 100 employees and they laid 2 of them off, and they made them an offer and the 2 employees rejected, but then they hired 2 people to replace them. How does this company calculate their number of FTEs, and is there a reduction? Well, if you look at this FAQ, it says you can ignore these 2 people leaving for purposes of the 2 wage and headcount and wage reduction rules. So does that mean the FTE count is now 102? Right, it's 100. You don't reduce it for the 2 that you laid off, and then you add it, you increase it by 2 for the ones you hire. And so it's either 102 or 100. We don't know, but either way, the employer is not going to be punished under the headcount reduction rule. But what about furloughed employees? And so the example talks about if an employee is laid off and doesn't come back, but what about a furloughed employee who says, I don't want to come back? And this is just not addressed. We don't know what they're going to say. It should be the same result. It's a similar fact scenario, but it's just maybe they'll address this when they come out with the IFR. We don't know. But that they wanted to highlight that there's a difference between furlough and layoffs, and that may be significant under this guidance. And so this is something that's very important to consider. On this last slide, next slide, we list a bunch of dates here, and this is important. We just wanted to highlight these so you have them because there's so many dates floating around. We wanted to clear it in our heads, first of all, and make sure we understood it. So I won't go through this here, but all the dates are here to go through these calculations. We wanted you to have them in one spot with an example so it's something you could work through. Let's go to the next slide. You want to do this one, Lou?
Yes. So thanks, Dan. That was great. Challenging. I've got a couple calculations that I still need to review. But with that said, there's been a turn of attention to now some bad publicity on the program. And what I did is last week, CNBC had an actual presentation on television, and they listed all these companies, which are also on a public company disclosure of companies that have returned their PPP loans. Now, Dan, if I'm correct, all these companies under the program qualified. And you say to yourself, well, how does AutoNation get 77 million when it was only 10? But AutoNation is a conglomeration of dealerships. So each dealer, they had amount of dealers apply, they got 77 million in combination. I guess Ruth's Chris must have had two $10 million PPP programs based on if they're whether they're a franchise or they're in the restaurant business.
Yeah,
Which
they had
is,
two separate companies. That's why they had two loans for 10 million each.
right, and the restaurant industry was excluded anyway for the 500 employee amount. So everybody heard about Lakers, Cura. There is one on here that I did find that is a little bit of an interesting story, and I'm going to pull out. It was on the construction dive. I know some of you on the call may follow the construction dive. I absolutely love it. I post a lot of stuff on LinkedIn from it. But the construction dive publicized a company that was called Continental Materials Corporation. It's actually a very small public company that provides materials to the construction industry. And they are being challenged to return $5.5 million that they received. The problem with being a public company is these are openly disclosed to the public on the amount of PPP loan you've received. Withum, Smith & Brown, in our financial statements, we are disclosing the PPE program and the COVID-19 impact on the company in our subsequent events footnotes. But those are private company financial statements. Nobody gets their hands on them. So public companies have a disadvantage where they're being attacked by the public for funds they have received. So believe it or not, Continental Industry Manufacturer is actually going to try to defend keeping their money and not returning it. So it's going to be an interesting case to follow and see how successful they are.
Yeah.
And being in the construction industry.
Yeah, it's that I would add. It's very interesting because the decision to return is not based on the size of the company. It's based on the access to capital. And the SBA issued frequently asked question number 31, which is the topic here, and it's on the website. And this talks about access to capital and is the loan necessary for the business. So if you think about it, you know, the secretary, Treasury Secretary, and Marco Rubio are the two that are really criticizing companies for this.
Right.
If a company receives a $10 million loan, what does that mean? It means that their monthly payroll costs are about $4 million, right? Because it was 2.5 times payroll to get the maximum loan amount. Well, if a company's monthly payroll is $4 million, their annual payroll is $48 million, which means it's at least a $100 million company, right? Just using standard statistics.
Right.
So this is not just for small companies, it's for fairly large companies. And as you see on the list here, many of them were able to qualify and take out a loan. So the criticism is not that they're large, it's that they had access to capital and didn't need the loan. It wasn't necessary. Correct.
And Continental is only $111 million company. And there may be a couple of you on this webinar that do 111 million. But again, very common company in the construction industry. So I wanted to point that out. We'll see how that goes. The other thing too, on the next slide, Alana, which I brought up, this is some comments that, and I always get his name done wrong. It's Stephen Mnuchin. I always get his name, Mnuchin. Not a well-liked guy on TV, and I must say, personality-wise, it's like talking to a rock, I would say. He's very, he knows not to say too much, put it that way. And here are some quotes that he had said basically on the loans. And he had noted this word that is being used called large companies. And again, this started from the public company, but now they're threatening the smaller businesses with loan sizes of up to $2 million and above. They are basically saying that they are going to do a thorough review. Now, that word thorough review or review of the program for forgiveness is turned into the media to mean audited. I'm not even quite so sure the SBA or the IRS or the government has a staff to even audit these programs right now. But it's something very, very similar to like what we went through with Hurricane Sandy and Katrina and the World Trade Center. these are going to be probably carry a little bit more scrutiny, a little bit more kind of like integrity monitoring, and a little bit more proof that you needed the funds because of what they were used for. So I just wanted to put his picture up there, and he is challenging people that they could have criminal liability, so they are scaring people. There's no doubt about it. And the one thing that he had said when I was watching him on TV is he said that he felt the rules were clear. Now, I gotta tell you, that's hard to believe that he made that comment, because everybody knows what we were going through when these programs first came out. The other thing too I want to show you on the next slide is this is an interesting, I'm going to look over here to the right of my screen because I have it blown up. This is an interesting letter that the AGC sent to the U.S. Department of Treasury, Stephen Mnuchin, basically saying and supporting the construction industry's use for this program and how important it is to keep employees working. And as you know, the construction industry is an industry, while a significant amount of it was allowed to continue working, a decent amount of retail, skyscraper type building, and other type of construction were suspended. So what this says, they wrote a letter. They are trying their best to support mid to small size companies to keep these funds that were issued to them under the PPP program. So now we're in a period where the construction organizations are doing what they can to give information to the government and to the construction community in order to make ways to feel comfortable that you can keep these funds. So with that said, that letter went out. Other organizations are going to write letters. And then there was also a legal forum. There's, I guess, a group of attorneys that advocate for the industry. And I have found some stuff about the returning of the PPP funds. We are getting some questions from some construction companies who have fared the storm fairly well, that have received PPP funds. When in doubt, have a board resolution documenting the need for the funds. Look at a couple things that they point out. And let me just turn this.
And while you're looking at, if someone is thinking about returning it, the safe harbor grace period ends May 7th.
Yes.
So
the AGC in this letter is actually asking for an extension of that grace period because it is coming up on us in 3 days. And as we say, bad facts makes bad law. There were a lot of bad facts here, and I think Dan would agree in the beginning on this thing. And they're kind of backpedaling now. Let's face it, they are definitely backpedaling. The problem is all these applications went out. All professionals recommended doing the applications. And some of the things that you should do is document the uncertainties your business faced when you did this program. Look at your supply chain. Document some of the jobs that may have come down with COVID in the area. Once a job comes down with COVID, it's wipe and clean, and it's very expensive to actually clean a construction site. The inefficiencies that happen in a job, all of the safety meetings you have to have. These are things you can do. Some people are concerned that you should have used your current line of credit to fund the operations. However, as everybody knows on this call, we like to keep that line of credit available for receivable builds up, cost grade and billings builds up, and also for bonding capacity. As everyone knows, the construction industry is not an extremely banking friendly industry. And there were also a lot of concerns starting to surface with some bankruptcies, some concerns with construction industry getting a little too hot, taking on a little bit too much work. So hence, document your position for uncertainty, look at your supply chain, look at how you could be impacted. And it's not over yet. There's a lot more to come from this. So you're going to feel it. Believe me, it's coming.
And I think it's important too to document this while everything's fresh in your mind.
Yes.
The date when everything matters is the date you signed both the loan application and the loan documentation, the loan agreement, the note. And so anything after that date is relevant to support your conclusion, but it's not relevant to your state of mind when you sign those two documents. So I think, yeah, so we are recommending, if you haven't done so, do a detailed analysis explaining what Lou said, why you need the line of credit, how that line of credit was essentially used up for other purposes and unavailable to fund your employee payroll costs. And so by
Yeah.
doing that, you insulate yourself from a charge down the road and/or from a need to return it by May 7th.
Correct, Dan. What we're seeing in the construction industry too, we're coming off the winter months, which are typically for some industries a little slower. So we're actually seeing companies that have applied for the PPP, got the money, but then they're actually hiring more people. And they're growing their businesses because they're still allowed to continue to work, which, let's face it, has upset a lot of people. The construction industry was the biggest use of the PPP funds so far. So a lot of people are upset. Hey, you got the most amount of money and a lot of state governors allow you to continue to work. So be prepared, document. And also you got to realize if, with that spring startup, everybody knows the spring startup of construction with all the labor, all the jobs, all the mobilization, you're carrying large receivables. You could not have done this and taken the risk in this environment without knowing there was this PPP loan. Document, document, document.
Okay, so now we'll focus on, I'll go quickly. I know a lot of tax people are on the line, so I'll try and shorthand these tax provisions, but we think they're important to be aware of. The first one is the employee retention tax credit. And I won't go through all the lines of the slide here, but what this is a tax credit that is available only if no PPP loan is obtained. If a PPP loan is obtained, you cannot take this credit. So it's either or. And so if you don't get the PPP loan, this is the next best thing. It's a $5,000 credit per employee for wages paid, but there's two conditions to get in there, and it's like the fourth or fifth bullet down. It says it applies to employees whose operations were fully or partially suspended due to a COVID-19 related shutdown order. So here I would think of like the restaurants, right? Either like the restaurants where they no longer have in-room dining, but they have takeout and delivery. There's a partial suspension of their operation. Second is this substantial gross receipts test where they decline by more than 50% relative to the same 3-month period in 2019. So if you meet one of these two requirements, this is a great program to take advantage of. $5,000 credit per employee, and the amount, the employees to which it applies varies depending on whether you have more than 100 employees or less than 100 employees. But again, we'll go to the next slide in the interest of time. The next slide is in the employer payroll tax deferral. And this is, quite frankly, a provision everybody should be taking advantage of. It applies to all employers, regardless of size, regardless of number of employees. It's an interest-free loan that the federal government provides. And what it does is it allows the employers to defer the employer's share of the Social Security payroll tax, which is at 6.2% of all wages up to $137,700. And it applies to all wages paid from March 27th to the end of the year. There's no special election. What you do is you calculate the amount of those payroll taxes, and you reduce your deposits that you make for your employment taxes, and you can offset against all your employment taxes that are required to be withheld. And so the limitation that applies here, the amounts that are deferred are repayable half by the end of 2021 and half by the end of 2022. So it's quite a good, 1.5 to 2 year interest-free deferral. The only thing to point out here is that if it's not keyed off getting a PPP loan like the other one was, the tax credit was, this is keyed off of forgiveness on a PPP loan. So once you obtain forgiveness on a PPP loan, this deferral stops at that point. So you can defer up until the point that you obtain a decision from your lender that some amount of your loan was forgiven, and you can no longer defer future wages, future employment taxes, but the taxes that were deferred up to that point in time continue to be deferred to this on the same time period, half by the end of 2021, the other half by the end of 2022. So this is a great provision to take advantage of interest-free loan from the federal government. So we'll turn to the next slide. And then we get into questions. So how do you want to handle this? Do we have any from the internet, or if we take something we got in advance?
Is Alana, who's getting the questions? I think it's Alana. I don't see any on my screen.
Lou, they're in your
Hi,
email.
Dan and Lou. I did send them to you guys via email.
Oh, by email, okay. Let's pull up the email. So Dan, here's a question. This is a good one too. If a laid off employee does not want to come back to work, wouldn't that technically make them ineligible for unemployment benefits? They were offered a job back and did not accept it.
That's exactly right. Yeah.
That's correct.
The fact that the person was offered a job at a comparable wage makes them ineligible for unemployment. And but it doesn't mean they can't still do something improper, right? So you give them the job, they don't take it. Technically, they should have to notify unemployment. They were offered a job and they're ineligible. If they don't do that, they'll continue collecting improperly, and that would be illegal because they're not doing what they're supposed to do. The employer's remedy is not the best. The only remedy for the employer is to notify unemployment that this happened. And then,
Yeah.
most companies are not going to go that route. But a way to do it might be to incentivize the employees by reminding them that of their obligation. So sending them a written letter, like along that FAQ 40 we talked about earlier, a written notice saying, here's your job. We want you to come back. And by the way, you're now ineligible. Even if you don't take the job, you can't get unemployment. You get nothing. So
Correct.
you're better off taking the job.
Here's another question. Okay, so if someone was laid off unrelated to COVID, example, a construction job is complete, do we get penalized on that person's wage reduction test? They had wages in Q1, but none during the 8-week period.
This is a good question, and I think it's potentially worse than the questioner is asking. There's two potential punishments here. One is you didn't bring the person back, so your FTE count's going to be down. Your full-time equivalent count will be off by one person, assuming they were full-time. So you're going to have a reduction for the head count. You'll also possibly have a wage reduction because you're paying them zero now in the 8-week period, and they were getting paid in the base period in the base period, which is a problem. We think that they're going to come out with a sensible rule that says you only suffer one reduction, not two. If you suffered the double reduction, you have potentially 175% punishment for the person's wages, 100% on the head count, and 75% on the wage reduction rule. To the extent it exceeds, a 25% cut in their wages, that would be the reduction. So we don't think it's going to apply twice. That would be really punitive. But even once is a punitive measure. And if you hire someone, it's not clear you get to offset that wage reduction, that possible wage reduction. So the rehire scenario, it's not clear. We hope they'll fix that in guidance.
Yeah, Dan, we do have this problem. We've had some construction jobs shut down. So what some of our employers elected to do, and here's where it gets dicey, is you continue to pay the employee while they're at home, which is what the PPP program was about. But is that really fair to the other employees that are taking a risk by working on jobs that are still going? So other companies have thought about other ways to keep them busy. Do they help clean out the shop? What can they do? There's got to be a way that they could add some kind of value. But it is one of the issues that the industry is facing with.
There's two things I would say. One is try and separate the moral issue from the purpose of the statute. The statute was they're compensating you to pay your employees regardless if they work. And I know it's odd in this case where some are working and some are not. That's one thing. The second thing is it's not clear the extent to which you can reallocate the money. And so we know you can reduce someone's comp by up to 25% and suffer no punishment on the forgiveness calculation. But to what extent can you reallocate wages from one person, that 25%, can you reallocate that to the person that's working? And so there may be an opportunity, depending on how the final guidance is written, to reallocate wages to pay the people that are working slightly more and the people that are not working slightly less, if you're so inclined. Now, there's no obligation to do that, but for people who are having this concern and think it's bad for morale, you may want to incentivize the employees who work versus not, and then rotate it. The employees who work, you can rotate that group so everyone has a fair shot of getting that additional compensation. But that may be a way to remedy it. We just need to make sure that they don't view it as a prepayment. When you pay the people more than they're getting, they don't want that to be viewed as a prepayment of future salary. It has to be compensation for that 8-week period.
Great. Here's an interesting question. So since the government is killing the expense reduction so far, hopefully it will get changed, but which essentially means that you do have income. does it make sense to elect to go with just paying the loan off and not taking and taking a deduction?
It's a good question. I think it's a bit rash in a sense.
Yeah.
So I think this is where we really suggest people model out what their forgiveness calculation looks like. And so we have not to do a sales pitch for Withum here, but we have a scenario calculator that we've prepared. It takes about 2 hours of time, 3 hours of time, 4 at most, if we need to walk through the data with you a lot. But if you send us the data, it's a couple hours of time. We can model out different scenarios and you can see what that calculation looks like under various scenarios. In general, if you have employees that are working and you're paying them anyway, you're always going to be better off taking the loan, even suffering some reduction in forgiveness because some amount will be forgiven. And anything forgiven is better than nothing forgiven. So if you have people that are working, you're always better off taking the loan. Now, if none of your employees are working, that's a different situation, because you don't want to end up in a situation where you're paying people not to work and you get punished with a reduction in forgiveness, which means you have to double pay. You have to pay the people and then repay the loan. And that's where we call that a cost in our scenario calculator, because let's say it's a $100,000 loan, you pay your employees $80,000, but you only get forgiveness for $60,000. That additional $20,000 you're paying the employees and you have to repay the bank. And so that's a cost of $20,000. If they're not working, it's a waste of money, right? It's not a fruitful use of the money. So, if the people are working, you're always going to be better off paying the people and suffering some reduction in forgiveness. And this is where a few hours of time with your accountant, if that's us or somebody else, will really save you a lot of money, and you can plan this out. And by modeling out different scenarios, you'll see where you're better off spending your money. And it may be that your overhead's too high, you reduce some of that. It may be your wages are too low, you need to increase it by hiring other people. And so I think having that information, Aaron, puts you in the right position to maximize the forgiveness amount. Going in blind is a true waste of time and money.
Correct. And if you were going to get a decent amount of money under the PPP program and kind of knew you weren't going to have payroll costs, then wouldn't the EIDL loan, the 30-year loan, may have been a better option if you plan to reopen again in the future?
If you could get it, yes. The nice thing that has an interest rate, I think, from 2.75% on a for-profit. The PPP is 1%.
Yeah.
So PPP is capped at 2 years.
Yeah,
and
2 years.
So there are trade-offs between the loans, but if you're not going to use it, it's not the best thing. So there are trade-offs on this.
Correct. And this is a good question, and I think I may be able to help with the answer because I've actually asked some insurance brokers this question. Is that so a company elects to pay their employees using the PPP loans while they're at home and they're not working. Those wages still count for the PPP forgiveness, even though they're at home sitting on the couch watching Netflix. Correct?
Yep. Yes.
Here's the thing now. It's not fair to pay their typical workman's comp rate on those payroll. So we are recommending our clients that have those situations to track those payroll costs for someone sitting at home, because you should not be paying a premium for workman's comp rate on that payroll.
Correct. That's a business decision. You go to your insurer and have them reduce it, is your point.
Correct.
Yeah.
Correct. I also believe that same thing applies to union. If somebody has any union in payroll and they are not reporting to work and not performing their local requirements per the union agreement, but you elect to continue paying them, you do not need to pay, from my understanding, the union benefits because they are not performing a function according to the union agreement.
Mm-hmm.
So that's another thing that came up at a webinar.
I notice we're out of time here too. It's at the top of the hour here. But
yeah, so that was it. Those were the questions, some good questions, and it is 5:01 on my computer, and I'd like to thank everybody for participating, and hopefully I can bump into you at one of the construction organization events. Maybe I'll have to drag my partner Daniel out there and show him how much fun it is, our events versus some of those other boring events the other niches have.
I'm sure they are, especially the tax ones.
Yeah, that's why I'm in the construction niche,
Yes.
It's fun group of people. And thank you very much for the New Jersey Subcontractors Association for hosting us today, and New Jersey LICA members on board. Take care, everyone. Be safe.
Thanks, everyone.